What collapses first? The banks, the currency, or the illusion that any of them were safe? Why do we trust our financial system? Why do we assume money is solid, stable, guaranteed? And what happens the moment that confidence cracks? History has a brutal answer. Collapse isn't rare, it's predictable. And no event proves this more than 1907, when the U.S. economy fell apart so violently that the government couldn't stop it. And one powerful banker had to take control. So why did the crisis happen? Who saved America? And how did the chaos of 1907 force the birth of the Federal Reserve? Let's uncover the story they never taught you. At the dawn of the 20th century, America believed it had finally built a financial empire too powerful to fail. The skyline was rising, factories were booming, railroads were stitching the continent together, and money seemed to flow without limit. To most people, it felt like the country had outgrown the chaos of the 1800s and stepped into an age of unstoppable prosperity. But here's the question nobody bothered to ask. What holds the entire system together? Strength, or the belief in strength? Because beneath the roaring stock markets and the gleaming bank buildings was a truth almost everyone ignored. There was no central bank, no federal oversight, no safety net, no one to catch the system if it stumbled. Every deposit, every loan, every paycheck rested on one invisible foundation: confidence. And confidence is the most fragile asset in finance. Back then, if you walked into a bank, there were no guarantees waiting for you. Your life savings were not insured. Your deposits weren't protected. Your bank statement wasn't backed by anything other than the hope that your bank was respectable enough, stable enough, lucky enough to survive another day. The entire system was a pyramid of trust built on reputation rather than regulation. And yet, people believed it was indestructible. Why? Because nothing had gone wrong recently. And in finance, recent memory is often mistaken for permanent truth. America's financial titans, the Morgans, the Rockefellers, the insurance trusts, the private banks, were treated almost like gods. If they were wealthy, people assumed they were wise. If they were powerful, people assumed they were trustworthy. And if they were gigantic, people assumed they were safe. But history shows us the same pattern every time a system becomes too confident. The taller the tower, the easier it is to forget how weak the foundation is. And the more invincible an institution appears, the more catastrophic its failure becomes. The early 1900s weren't an age of stability. They were an age of illusion, a financial world built on optimism, inertia, and faith in giants who looked unshakable right up until the moment they weren't. And in 1907, it took only one spark, one scheme, one failure, one crack in the facade, to expose just how fragile America's financial titanism truly was. Every financial collapse begins with a trigger, a moment so small, so specific, so seemingly contained, that no one realizes it's about to detonate an entire system. For 1907, that spark came from a gamble, a reckless, ambitious, and ultimately disastrous attempt to manipulate the market. It started with two bold financiers who believed they could bend the copper industry to their will. Their plan was simple in theory and catastrophic in execution. Corner the copper market, buy up as much as possible, squeeze supply, force prices upward, and walk away with a fortune. But schemes like this only work when the world plays along, and in 1907, the world didn't. When prices didn't rise fast enough, their empire of leverage began to wobble. Loans suddenly looked enormous, positions turned toxic, and the bankers who quietly backed the operation realized, too late, that they were tied to a bomb with a burning fuse. Here's the part the public wasn't supposed to know. One of New York's major trust companies had been helping fuel the scheme, not openly, not proudly, but quietly, behind closed doors, hoping no one would ever connect the dots. Then the collapse hit. When news leaked that this respected trust had been involved in the failed copper corner, depositors didn't ask for explanations. They didn't wait for statements. They didn't want reassurance. They wanted their money, and they wanted it now. Crowds formed outside the building. Lines stretched down the block. Whispers turned into panic. Rumors spread faster than facts. Inside the trust, clerks scrambled to pay withdrawals. Vaults emptied. Reserves evaporated. And the moment people realized the trust might not have enough cash to satisfy everyone, the panic became self-fulfilling. This is one of the oldest truths of banking. A bank doesn't have to be insolvent to fail. It only has to be doubted. By the end of the week, the trust had collapsed, but the damage didn't end there. Once one domino fell, the public began looking for the next one. If this trust was involved in shady schemes, what about the others? If this institution couldn't survive a wave of withdrawals, which bank could? Confidence cracked, and fear rushed into the space it left behind. Banks that were perfectly healthy became targets of suspicion. Trust companies with no connection to the copper scheme were suddenly overwhelmed by depositors demanding their money. Newspapers fed the anxiety. Competitors whispered rumors, and the financial system, already stretched thin, began to shudder. This is the second lesson of 1907. Crises rarely begin with the biggest institutions. They begin with the weakest link and spread to the strongest. A single failed gamble in the copper market exposed the fragility of America's entire banking structure. It proved that the line between prosperity and panic was thinner than anyone wanted to admit. And it showed that when trust breaks, it doesn't matter where the fire starts. It will burn through everything. When one trust company fell, depositors assumed others would be next. Lines wrapped around blocks. Cash reserves bled dry. Banks that were perfectly solvent on Monday were fighting for their lives by Wednesday. Merchants couldn't get credit. Factories couldn't make payroll. Railroads halted expansion. And ordinary Americans discovered that the money they thought was safe existed only as long as everyone else believed the same thing. This is another ancient lesson. Banking relies not on money, but on the illusion that the money will always be there. Once fear enters the system breaks. With no Federal Reserve to coordinate a response, the U.S. government turned, reluctantly, to the only man with enough influence and liquidity to stop the collapse. J.P. Morgan. Not the bank, not the corporation. The man. Morgan gathered America's most powerful bankers inside his private library. He locked the doors. He placed the key in his pocket, and he told them the truth. If they didn't work together to save the financial system, it would fall apart before sunrise. Throughout the night, Morgan personally evaluated which institutions could be saved and which had to be allowed to die. He forced rivals to cooperate. He demanded emergency loans. He ordered mergers on the spot. Hours later, the panic began to slow. For the first time in American history, the survival of the entire economy depended not on Congress or the Treasury, but on one wealthy private citizen. That is the most unsettling lesson of 1907. When the system collapses, power flows to whoever has liquidity, not legitimacy. The crisis didn't end America, but it shattered the illusion that the financial system could survive on trust alone. It showed that, without a central stabilizing institution, the U.S. was vulnerable to every rumor, every panic, and every market manipulation. Politicians claimed they were shocked. Bankers claimed they learned their lesson. But the truth was simpler. America had outgrown its 19th-century financial machinery, and the panic of 1907 exposed its weaknesses in brutal detail. Within a few years, Congress created the Federal Reserve, not out of innovation, but out of fear that another 1907-style panic would eventually destroy the entire economy. Across centuries, across continents, the themes are always the same. The institutions change, The logos change. The technology changes. But the underlying physics of collapse do not. Trust collapses faster than any currency. Liquidity becomes a superpower. Those with cash or real assets dictate the terms of survival. Systems built on confidence implode when confidence cracks. Centralization always rises from the ashes of chaos. Just as gold protected Byzantine merchants. Just as land protected survivors of the Black Death. Just as hard assets protected Southerners during the Civil War. Liquidity and private capital protected the elites of 1907 while ordinary savers stood outside locked bank doors. Collapse punishes the trusting and rewards the prepared. Think the lessons of 1907 are ancient? Think again. In 2008, when Lehman Brothers fell, the system froze almost instantly. In 2020, trillions were printed to keep society functioning. In 2023, regional banks collapsed in hours, not days. The pattern is unchanged. Only the speed is different. Every crisis shifts wealth from those who assume stability to those who position themselves for its collapse. That is the real legacy of 1907. So ask yourself, when the next shock hits, and history guarantees that it will you be the one holding paper promises? Or will you be the one holding something real? History doesn't repeat, but if you ignore its patterns, it will break you just the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.